Mr. Mark Selby. How are you, sir?
I am good, Mr. Matthew Gordon. How's your week been?
My week's been a little bit lively, actually. Yeah, I've
Ah,
been trying to sort of a few things down out in Chile. They have made admin an art form down there, so we are wading our way through that.
excellent.
Such with a smile on my face.
The joy of bureaucracy. There you go.
I know you think the British Empire were something. The South Americans really have outdone themselves. Right. Well, we better talk about the forecasting genius, which is you. Telling us a little bit about what's been happening with nickel and what do you think is going to happen with nickel. So we should start with the price.
Yeah. So, as we sort of followed on last week, we broke $22,000 a ton, $10. The next level in sight is 20,000. As I said last week, I don't, given where costs are, and we talked about costs last week, I think any drop below 20,000 will be limited, for a period of time. But this week we've basically hung in around the $21,000 a ton level, 950 for those per pound. And again, LME inventories are holding at very low levels. We're not still seeing any kind of inventories come back in the market, and generally, we are seeing some stainless stuff comes down, but as I said a couple of weeks ago, this is really a pivotal period. At the beginning of the year, I highlighted this, great convergence that's going to occur as LME prices come down and MAT and NPI prices come up, because we're finally going to have enough capacity to convert any surplus in the nickel pig iron part of the world and have it move over into the MAT or LME deliverable material, which will end up, allowing prices to reconverge to quote kind of normal long-term levels. And yeah, again, with the first drop in price 2 weeks ago, was great. We saw both the discounts for sulfate compressed by about 10% and the NPI discounts compressed by about 15%. So, with another, 5% drop this week, it'll be interesting to see when we get the Chinese data next week, whether, we'll see a further compression in those margins. So, that's a process that, I think will take the remainder of this year and into early next, but it's good to see that we're kind of finally underway and kind of normal price signals for all the different market participants will start to emerge there, which is helpful.
Right. And if we also go back to the conversation we had a few months ago with regards to Goldman's bullish calls on commodities, how do you think they're feeling about it now?
Yeah. So there was interesting news this week. They had a pretty outright bull call on commodities as I think the top performing sector for the year coming up. And again, underpinned by strong demand growth, lack of supply coming down the pipeline. The challenge here is, again, we had a whole wave of restocking in the battery side. As we've talked about, it's, the lithium prices collapsing, which caused, the entire battery supply chain to destock, which had impact on nickel, cobalt, graphite, and so forth. So, the good news is lithium prices are really starting to rebound. We had another big week over the past week in China on lithium prices. And then, where Goldman's coming out at, and, this is to the extent I, sort of talked about as well, too, is that, when you get a period of destocking and you've got a very high growth market, that restock to catch up to where the demand is gone can be pretty aggressive. And so, they're still calling for a big increase in commodity prices across the complex. And so, they think we'll see a massive restock rally, as we get into the second half of this year. And they're blaming their missed call, on this destocking that we're seeing across a range of commodities. Again, also exacerbated by the fact of, with the, people nervous about whether we're going to be in a recession or not, and really sort of ratcheting, the amount of inventory they're carrying down to pretty low levels.
So let's talk about that. Let's talk about the debt deal, okay? Because I've seen headlines all across Google and wherever I look, but it's all contrary.
Yeah,
I'm not sure people know what the heck's going on. Because if I sort of key in the words, debt deal, first page on Google return I get, we'll start with this one. Lack of debt deal sees gold price drop.
Yeah.
Okay, drop. Literally the very next article, Wall Street slides back on lack of debt deal, gold surges.
Yeah.
So, and if I go down the next sort of 2 pages of Google, it's all contrary. People trying to interpret what's going on, what it could mean. Now, clearly, I think the big banks are looking at this in the context of much bigger markets than just our tiny little natural resource, our mining space. But M&A deals are stopping. Deal values are plunging. Access to capital is harder, more expensive, if you can get it at all. People are paralyzed. So, again, your view, North American view on what's going to be happening down there, what we're going to see. A deal's going to be done last minute, surely, as it ever is, isn't it?
Yeah, no, I mean, I think a deal's going to get done. Unfortunately, whatever the actual time on the clock, that's the deadline. It'll be, 90 seconds before that deadline. And again, I think it'll be an agreement to agree. And it might even, they'll be able to keep things going, but they'll still actually have to hash it out for a little bit longer. It's too bad the world's biggest, economy is got a dysfunctional government, but that's the reality that we're dealing with. Again, this is all short-term noise. These are the times where you can, are buying opportunities. In my space, in the nickel development space, we did a financing back in early March. Again, in terms of the fundamentals of the nickel market, there's been no change in that at all. And, the entire junior mining development complex is probably off 35-40%, in that time frame, and who knows, we might see another 5 or 10% in this week if things look pretty panicky around this debt deal. But those are the times where you can pick up your favorite stocks cheap. So that's the key thing here is always use short-term noise to better your long-term story. Like that's bottom line.
That's bottom line fact. Do it. I could not agree more. It's a fantastic time to be picking up deals, and I think what we're going to be certainly doing in the background, and and I think we enjoy the conversations with you for the same reason, is that deals that have strong fundamentals in terms of the project itself, its ability to get to a point where it will produce cash, whatever the commodity, it can produce cash and free cash flow at that. That's all good news. And really, I'm listening to the management teams of those companies saying, right, how are you going to do that? There will be navigation of, say, short-term noise like this. There'll be navigation of the markets. There will be the odd occasional, slightly more expensive raise. But the point is, you've got to advance the projects through and kind of create that end value. And perhaps we can talk about that another time, because I think you've got a little bit of news coming up with your Texmont project, and I suspect I'd quite like to talk to you about your energy capture and storage project too, but maybe that's one for another day. But some of the companies that are doing well, let's talk about some of those now in your space. And I think you've got a little bit of news yourself, I saw in your press releases as well. So should we start with the others?
Sure. Yeah, no, it's good to see. So Centaurus, who's advancing the Jaguar project down in Brazil. Again, one of the few new sulfide deposits discoveries, and they're pushing forward. They had some good metallurgy results last week. This week they're now looking to step out at some of the other targets that are nearby. And again, you often get nickel deposits occurring in clusters. So it was good to see, a target that's just 5 kilometers away from where the main Jaguar project is, 14% nickel, 14 meters at 1% nickel, 11 meters at 1%, relatively shallow, and the structure they're seeing, outcrops all the way up to surface. So, again, that's one of the event, once you get the main operation going, having additional resources, it's much easier to add that incremental, stuff into the mine plan. So, that was great to see. Another one, SPC nickel, they pulled off, Vale is notoriously difficult to negotiate with, and kudos to the SPC nickel team to get a deal together to them to consolidate, what is effectively a single deposit that was split in half between owned by SPC nickel and Vale. They've now put that one deposit together. And again, it's a decent chunk of nickel resource that's close to surface. And they had some, great intervals, where they had, over 20 meters at 1.7% nickel, 0.46% copper. That was within a bigger interval that was 1% nickel and about 0.5% copper. Again, at shallow, that interval was a little bit deeper, but again, this is mineralization, that comes all the way to surface. So good to see, those kinds of results coming from that program. EV Nickel, who's one of our neighbors up in Timmins, doing some met testing. Again, you generally know what you're going to drill when you're drilling met holes, because you're drilling within your existing resource. But again, good to see long intervals at decent grade. So that EV4 deposit they have, or sorry, W4 deposit. It's good to see these kind of grades where it's like 72 meters at just under 1% with a 30-meter interval, around 1.5%. So good to see that. And then with us. Again, we've been talking about stepping around, highlighting the exploration potential of our regional properties. And so, the key thing with that is we've been drilling them not necessarily from the absolute highest potential one first, and then working our way through. We've needed to negotiate First Nation exploration agreements and other things, seasonal conditions with certain properties. So we're basically drilling them, as we've been able to get access to them. And so, what we're calling through a walk through the giants is a property that we have an ability to earn into 80%, with Noble Mineral owning the remaining 20%. So the first target, Man Northwest, first set of holes hit all the kind of mineralization that we're looking for. We've only drilled, literally less than half the width of where we are. It'll be interesting to see, how many hundreds of meters it goes wide. But again, we've got our geophysical targeting that, allows us to zero in where the resource is. Crawford's the largest sulfide discovery since the early 70s. That's on a footprint that's about 1.5 square kilometers. Man Northwest, the first target's almost four times as big as Crawford. The next one in that chain in Man, we call Man Central. That's almost double Crawford. And then there's another target, Man Southeast, that's almost 2.5 times Crawford. And that continues into another township where we own 100% of it, which is about 1 to 1.5 times the size of Crawford. So, again, when we talk about unlocking an entire nickel district, unlocking a massive amount of sulfide resource, it's these kinds of targets that we've got. And this joins a list of, Deloro, Texmont, Sothman, Midlothian, Bannockburn, and Reed, where we've already drilled, and had real success, on those properties. Again, and just the scale of what we're doing, both Midlothian and Sothman, we had over 300 meters at, just under 0.3% nickel. And again, starting shallow, one of the challenges in this area is you've got an old glacial lake bottom that sits on top of the rock. Down further south, the depth of it is quite shallow. So we're looking at 2 meters at Midlothian and 15 meters in Sothman. So, very, very happy with, those kinds of drill results. And again, we'll continue to step out around the rest of the properties, as we work our way, work our way through the rest of the year.
Okay, so you're very busy at year end. I think I've referenced the fact that I think there's probably going to be a little bit of news out of Texmont soon. That's your kind of, I guess, the early production opportunity that you've kind of set up for yourselves. So we can talk about that maybe in the next couple of weeks. And also, I would like to sort of talk about the energy capture and storage. Energy capture? Did I say energy capture?
Carbon capture and storage.
Exactly, carbon capture and storage. Energy capture would be quite cool too. Maybe we can do that next time. Okay. So let's come back to that. I mean, but so the general sort of, I guess, mood of the nation is, I mean, for me, this lack of debt deal is like creating a, quite good buying opportunities across the board, but you must focus on the right things. Don't get distracted by the noise and promises. Do the work and look at the companies which have got the right assets and have got the right plan. And quite frankly, even I like the companies that can actually stop, breathe, take a look around and go, do you know what? If we think this situation is going to the economy is going to keep going at this rate, we're going to have to do something. Whether that be like, bring in slightly more expensive capital or use the capital we've got in a different way, and kind of repurpose the business, but I mean, change enough things that it can get noticed and credited for in a way that a lot of companies are not being credited for at the moment. And, good companies and bad companies are being viewed the same way, which I think is slightly unfair. I think it's also slightly short-sighted of investors if they're not taking advantage of the opportunity. But, I can say that all day, every day, and only very few people will actually pay attention and take advantage. But that's again a discussion for another day. So your general view in the mood in the nation. Obviously, I think battery metals companies still walking with a kind of skip in the step, apart from the equity prices, in terms of the long term view.
Yeah, no, I mean the business fundamentals, and I don't know if I mentioned this on last week's call, but again, another sort of nickel development CEO talking about the fact, it would be great if we could just tape record some of the conversations we have with the battery guys and the car makers. And just play that so that investors really understand the scale of the increase in raw materials that these guys need and how far behind the curve they are in terms of getting those raw materials for the later part of this decade, and to fill battery plants that they're already building and car platforms that they've already committed to building by a certain time frame. So that's the fundamental reality. And again, as I've said many, many times, this market is the biggest disconnect between the business fundamentals and investor sentiments. Since 2002, the only time I've seen it worse was 2002, when people underestimated that China was actually going to happen or not. So that's the scale of where we are right now with the EV disconnect.
Keep the faith. Keep the faith. Mark, good to see us ever. Thanks for the update this week. We'll see you next week.
See you next week, sir. Take care.